Hi, I'm Lance. Welcome to Feel the Boot, a channel with tips and advice for startup founders and interviews with entrepreneurs and experts. I first interviewed Che Voigt a couple of months ago. He's chair of the North Bay Angels and co-founder and CEO of Altwork. If you haven't seen that interview already, I'll put a link down in the description. Last time we talked, he was about to launch a new version of his product, and we're right in the middle of the COVID lockdown, and we agreed to meet back up to discuss how that process went. Little did we know that right after that interview, the entire Black Lives Matter unrest broke out, and it seemed inappropriate for him to do a big launch, so that ended up going in a completely different direction. So we started this interview by talking about how he adapted to this rapidly changing situation. We also talked about his experience with fundraising as well as being an angel investor. We talked about what kind of companies are appropriate for angel or VC investments and how the entire investment ecosystem and environment has changed over the last few years. More than almost anyone else I can think of, Che has thought long and deeply about all aspects of the startup process. In this interview, he shares many of his profound insights. Enjoy! Che, welcome back to Feel the Boot.
Thank you, Lance. Happy to be here.
So when we talked to you last time, now a couple of months ago, you were about to launch a new version of your product, and it was right into the teeth of the COVID crisis. And we talked about getting back together soon. It's been longer than I expected, for a follow-up on how that came out and what you experienced. So for anyone who didn't get to see part one, maybe you could talk real briefly about what your company does, and then let's hear how things turned out.
Sure. And for those people that have watched the episode one of this, boy, did I need a haircut. So that was that's the COVID time, right into the middle of that. 2020 has been able to exceed all of our expectations, but not in a positive light. 1-star review, we all know that. But what the company does, so what Altwork does, is we build what we feel is the world's greatest way to work with your computer. It's a workstation designed to support your monitor, keyboard, computer, etc., that goes from standing to sitting to full recline. The magic of the Altwork station is not only does it do that in a very compact, etc. environment, but it moves around the body. So instead of where people are like, oh, well, I have a stand-up desk and you have to move your chair out of the way, you have to do this, you have to do that, you have to readjust everything, it just moves seamlessly around you. Now, as the world has shifted to a work-from-home environment, it's been huge for our sales. There's been just a giant shift, not only in what people want to do with their computer, but the fact that their computer is now representing not just their work, but it's also in many cases a level of social life, family interaction, schooling, etc. So the time at our screen has just skyrocketed, and the ability to be comfortable, be productive, and be ergonomically correct in that position is a huge deal. Good friend of mine we were talking this through, and one of the things that I thought that she said that was really interesting, she has a very big job, C-level job at a public company, and she had a nice home office, and she said, this was great for one day a week. I kind of designed it so that I could get some work done on a Saturday. It's not working for me when I'm here every day. So it's not just that maybe you had a home office and maybe that, relatively inexpensive office task chair that you had there was okay, but it's been completely changed now. So that's what Altwork does. Please take a look at our stuff, and very interested in answering any questions about it, of course. But what Lance wanted to talk about is we were about to launch a product. And we accelerated that product launch because of all the shifts to work from home. And we were going to do that. And the launch date was set for June 3rd. And we were getting ready for it. We didn't know what was going to happen. And that's what I talked about with Lance. It's one thing to go ahead and say, oh, yeah, this is our plans. But then reality hits in. Reality for us, the Black Lives Matter protest news cycle, etc., was huge at that time. We had many other issues going on. The the Trump photo op at the church was in full news cycle swing, and we just decided that, you know what, really important conversations, we are not going to do anything to make noise about this. So we just quietly launched, we put it on our website, and we didn't do any fanfare whatsoever. We feel like that was both the appropriate response for our values and the pragmatic response, because what else were you going to do?
Right. There was no way you were going to get attention in that news cycle.
Yeah. And would we want it? Right? There's other stuff going on, and sometimes, I mean, this is for you, Lance, this is kind of like the world's greatest interview in terms of, so here was your plans, how'd it go? Not well. Because there was other stuff going on, and you just have to, you have to figure it out. That's a big part of business. I would love to be able to write a 5-year plan and have everything stay the same in the landscape, etc. Some stuff happens that is good, some stuff happens that's bad, some stuff happens that's just different. And this is a good example of, we had a great plan, but there was nothing we were going to do about the world events that were happening at that time, and we needed to adjust to them.
Sure. And this is why when we see companies pitching and they put together their 5-year financial plans, the one thing we know is that they're utter fantasy.
Well, and at least in today's modern world of pitch decks, one, if you remember back, 20, 30 years ago, the plan was, show me your detailed amount that you're going to pay on paper clips for the next 5 years. Because I really want to see as an investor that you've thought through all the details and you have the appetite to understand that. And I do remember reviewing some financial plans that were still like that, but nobody does that anymore. And it's honest, right? The amount you spend on pencils and paper clips is not going to be the thing that makes or breaks your business. It's important to watch all your costs. There's no doubt. I'm not saying anything differently than that. But in general, the financial plan has to show how big can this business become, what's its cost structures generally looking like, and is it the kind of business that is an investable type of business versus other types of businesses, which may be good and fine, viable businesses, but they're just not an investable exit type of business.
So what happened when you did this soft launch? How did that go?
Well, basically we got, fundamentally we announced it to our email list. We're fortunate enough to have a strong and engaged email list. We're above all the industry standard on the metrics, and we're trying to build that and be more engaging with that. This is an excellent example for us of, if we hadn't had that email list, no one would have really known about it. It would have been on the website, and that's it. Now, still at the same time, that particular model's been sold out for months. So, response was good to the model. It's been a great add to our overall product line, really helpful, and we hope it will be well received and become a big part of our business in the future. But it's, continuing to grow. So it wasn't, we still had good response, but we by no means had maybe the excitement that we would have hoped for in a more lower news cycle, a different news cycle.
Right. And as I recall, you also had issues with inventory and production because of the COVID situation and the manufacturing in China.
100%. And it's not just manufacturing in China, but it's also all the transportation, the ability to ship things in different locations, the rate of change in freight and shipping situations for those people that are involved with that in 2020 has just been really a problem. So just to make sure for those people that don't know, one, air travel dropped dramatically, as we all know. Now, what does that mean? That also means there's less aircraft that are carrying the little bits of extra room that they had to carry some extra packages and cargo. Those are now out of the landscape. Number two, PPE was at an incredible premium. Everybody needed it. No one was prepared to the level they should have been. all of us, ourselves included, leaned in and like tried to figure out what can we do, who can we contact, how can we help this very difficult situation. If you remember back then, we were talking about the terms wartime mobilization, and we certainly did that. We knew a lot of other people that did that, and so that meant that the aircraft that were flying were somewhere between hard and impossible to put anything else on. So we started, instead of shipping by air, we were taking other options, including trains and boats and all kinds of stuff that we hadn't had to consider beforehand. So that made everything extra interesting.
May you live in interesting times.
That is the curse, right?
So what do you think is there a systematic pattern between companies that seem to be doing particularly well during this crisis and are able to take advantage of it, and the ones that are getting particularly impacted, other than sort of the really obvious, like hospitality industry versus telecommunications like Zoom?
Right. Really interesting question. And I've lived through, several recession, depression cycles like you have. And from our point of view, we do see this one different, right? Because what we're seeing is an acceleration of a digital economy that maybe was very foreseeable, and a lot of people this is like the old-timey Silicon Valley view, way back, right? When computers were going to really just make the world a lot better place and change the very way we interacted, right? Mm-hmm. And for us, a good example of this is we just know now, because we've got enough feedback from various customers, et cetera, that many people are just never going to go back to work, right? Absolutely, some people will go back to work just like they did before, but there are going to be a larger than expected percentage of people that either are working from home, what we'll call most of the time, meaning they might go into the office occasionally, a day a week, 2 days a week, or for special meetings. But we have customers that are saying, no, I'm going to move our company to what we call remote first, meaning unless you have a reason, your meeting will be, maybe not on Zoom, but will be remote.
Right.
So we're seeing that happen. And then the other thing that I think is really important to notice is there was an article in the Wall Street Journal that many people may or may not have seen, but REI decided to never occupy their flagship headquarters that they had just finished. That's a huge decision, right? That flagship headquarters was more than one person's dream, right? And they decided that instead they would sell that location and open up satellite offices. To me, I see the satellite office as a great thing, for a good combination for helping employees work-life balance, reduction in the commute times and all the negative impacts that commute have on both people and environment, et cetera, et cetera. But the fact that somebody decided to build and fund that operation and never occupy it, and instead shift to a satellite office, is a big deal.
That's an incredible case of someone resisting the sunk cost fallacy and looking at where their business is actually going.
Right. I mean, can you imagine sitting in the room? There were a lot of people in that room with a lot on the line, and a lot of just like, why don't we just occupy it for a little bit, right? So we absolutely see a shift, and for us at Altwork, it's turned more into a tailwind, and I got a lot of empathy for the people for whom this is an existential threat to their business, and they have to deeply change. We have some very close relationships with people in the hospitality business. There's been some press on us where we actually have Altwork stations at a hotel. If you wanted to go on a little bit of a mini vacation, get out of the city, and come up here to wine country area, you can also work in an Altwork station, do your work, and if you're going to be remote anyway. So we're seeing that kind of stuff too. Hotels are going to have to completely refigure out what they're doing for at least the near future, and we'll see what happens after that, of course.
It's interesting. I see a lot of companies pitching, and how many of them now are including something about COVID in their pitch. And it's gotten kind of to the point where you then need to think, is this new model that they're pursuing only viable during COVID, or is that more of a why now argument? But in fact, they do have something to go at after that happens.
Very fair. From my point of view, of course, there's going to be a boom on personal protective equipment, et cetera. But also, I think that people will no longer say, oh, well, we should have some of this stuff around just in case. The just in case feels more relevant. That will change, right? There will be a new normal that will change. Of course, we know that. But is it next year? Probably not. Is it 5 years from now? Yeah, that's more like it. And so, yes, for many of these companies that if they feel like they have only a COVID response, then yeah, that sounds very dangerous. I agree. But for many other companies, Zoom is probably the example of this one better than anything. We all kind of knew about Zoom beforehand, but now it's going to just be part of people's lives, and it won't be the only one, but it is now turned into the name that people use to refer to video conferencing.
That's right. Yeah, it's gotten the Google effect.
Yep.
So we started talking about investing and advising in startups. So how did you get involved in the startup community and end up being chair of the North Bay Angels?
Well, I grew up in an entrepreneurial environment. My father and his business partner met at General Dynamics, aerospace company, obviously, and they were engaged in some very high-tech stuff at the time. But they also decided to build the world's fastest human-powered vehicle in their garages on the weekends. And they did that. So the first year they went out, they had a 3-person vehicle that did 55.5 miles an hour, I think, something like that, just over 55 miles an hour. And that was impressive at the time, and it was enough to have a world's record by a few tenths of a mile an hour, right? What was interesting is they said, this has really worked out well. Let's do another vehicle. And they built an incredible vehicle that came out the next year, and a single rider went 58.5 miles an hour in that vehicle. And just from a world records point of view, it shattered the world's record.
Yeah.
If you look at the history of human-powered vehicles, there's been 2 times in 70 years where the speed record in a year was broken by more than 10% in the first year. First one, they did 10%, so it just barely made it, and then Al and John broke that record by 16%. So it was very significant. They said, hey, this worked out so well, why don't we combine our consulting companies and start a company together? And that's what they did. I grew up doing that kind of stuff. I was 9 years old, operating a milling machine, building that human-powered vehicle, and we did all this kind of stuff. So we solved a lot of really important problems. We did some very, very good work for a lot of people. However, the financial return portion wasn't in line with the work that we were doing. And I started getting involved with various people and really trying to study this more. I'm a mechanical engineer by training and didn't go to B school or anything like that, but we started studying this problem more because we were having real issues. And as a result, we've done better and better. So the first company we sold had some real cash issues at the time, and they did not get a good return. The acquiring company did very, very well. Mm-hmm. And it's great for the acquiring company to do well, but they it wasn't exactly a fair transaction. The next transaction was a lot better. And then I came in and we founded a company together with myself as chief executive. We built that company up, sold it exact 5 years after we built it, and all the stuff you're supposed to do.
Right.
And I could see very much that, one, it's a combination of you have to work hard. That's table stakes in this business, right?
Right.
When I hear entrepreneurs tell me, but I really want to work hard, I'm like, well, yeah, you're just going to do that. That's how this game is played. Number two, you need a basic level of talent, of course, right? That's also table stakes to a level. Experience matters a lot. And it's experience on how to solve problems, being there before, pattern recognition, and a bunch of stuff that seems almost impossible to define. I think that's all true. I'd love to hear your comments on that. So through the North Bay Angels, one of the things that we've been doing at the North Bay Angels over the years now is not just bringing together a bunch of people who are interested in angel investing for the returns, but also who are interested in angel investing to be part of the experience and to lend their expertise. And really, one, it can be a fun process for sure. However, it's really fun to help a person that you look at and you say, hey, this person really is working hard. They've got talent. They don't have the experience, but they're going to get it. But maybe with a little bit of help, they could get there with a little bit less pain. And I think that feels like, I can speak for myself, and I know other people on the North Bay Angels board that really feel like that's some real gratitude towards being able to help someone do better than they might have been able to do without us.
Yeah. Well, I mean, obviously, I agree, having started this entire channel for exactly that purpose. I think it's really interesting, your point about the experience and working with advisors. Of course, you're sort of borrowing their experience. Ideally, they can help you avoid making the same mistakes and go out and make new ones. And it is surprising, I think. You said it's hard to articulate what that experience is. It's in many ways a somewhat intuitive business. You try to do numbers, you try to be very systematic about things, but as a founder working in a startup, there's also a lot of kind of intuition calls that you end up having to make based on that experience and pattern matching.
I agree. And it's really a hard thing to do because, it's easy to watch a 30-minute pitch and throw a 1-minute comment back on something just based on what you saw. And you know what? Sometimes it's helpful. It truly and genuinely can be helpful. I've been helped by those little offhand comments in the past where you take that gut reaction, you're like, I got to think about that, right? A lot of times it's not helpful because you get, as the entrepreneur, as you've probably experienced, you get the same, 30-second, 1-minute reaction from somebody that hasn't really studied the problem, and I've gone through this with due diligence with either advisors or investors where you say, yeah, you would think that would be true. Here's what happened when we tried it. And then you got to go through the whole process of whether or not it was really a good test, maybe the timing was wrong, all that kind of stuff. But there is a difference between that nuanced part of, am I just beating my head against the wall as an entrepreneur because I can't figure this out? Or is the advice that I'm getting really just not appropriate for this situation? And that's the gut feel that is hard to figure out.
You're right. I mean, there's some advisors that you see that seem to give the same advice to everyone. They've kind of got the what do they call it? The hedgehog thinking, where they've come up with the solution to every problem and they try to apply it to each case. And of course, we all come with our own baggage and history and experience. And I always warn the people that I'm advising to be a little bit careful about listening too closely to any one advisor. But if you've got 3 or 4 and they're all telling you the same thing, that might be telling you something.
I like to joke when I tell these kind of stories is I give really good advice and you can tell that everybody's listening and they're like, this is great advice. And if I feel like that's happening I like to end that comment with, now 50% of what I've told you is wrong, but neither of us know which 50%, because it is actually true, right?
Yeah, right, absolutely. Well, I remember as an executive.
Business is about iteration.
Yeah.
Huh?
I remember when I was an executive and you'd walk into a room and you'd make some pronouncement and everyone would nod very sagely, like, oh, that's clearly right. Like, now, I know that I just made this up on the spot. It wasn't that brilliant. Someone should be disagreeing with me on this.
And that's, I think, another good point in a management team to look for. We used to call people yes men were the problem, right? Not an appropriate term today. But, you need to have the difference between someone that is appropriately critical of your plans versus the iconoclast that just has to be destroying the structure around them. Between those two items are really important people, and you got to cultivate them if you're a chief executive, it's really hard to get good advice, and good advice is about a relationship, right? What can you hear, all this kind of stuff. And yeah, when you're a chief executive and the plan has gone terribly and everybody says, well, I thought that was going to happen, you're like, ooh, that's really disappointing to hear, because it will.
Right, exactly. So what do you look for? When you look at companies and they're pitching and, you've only got a small amount of time to try to judge or analyze them, what kind of things do you look for that sparks your interest and wants to make you dig deeper?
Sure. So I think the biggest deal for me is to, one, try to quickly identify why this company is different, right? Many people talk about these angel type investments of being what we'll call technology plays, right? And not all of them exactly are. So the big question from my point of view is this really a technology play? Is it a marketing play? Is it a financial play? All these kinds of things. So one, identify what it is and see if the management team itself understands what the heck their difference is. A lot of people do not. They have not really been able to figure this out yet. Number two, whatever their play is obviously has to work, right? So the technology needs to work. The technology needs to be genuinely better and defensible. If it's a marketing play, which there are a lot of, right? There's a lot of people that make money just taking something that's not much different, but they can package the messaging to a different customer set so much better that it works. Can they articulate that, and do they know what the heck they're doing? And then the third thing, especially for angel groups, that I think is more important now than it's ever been, which is, why are you here? So for an angel group, do you really, if you need to raise $100 million to make this deal happen, it's not necessarily a good angel play. So a great example of that for us is medical device. Many medical device companies are a $100 million play just to see if it's going to work. And that's tough for an angel, because maybe they can help get the thing started. Maybe they want to do that. They have a particular reason. Maybe somebody close to them is afflicted with something like that, etc. But if it's really going to go big like that, they need the financial support of large institutional rounds, right? However, some deals that I know that you're in are small medical type plays that are probably not big enough ever to get somebody really interested from the large institutionals. But they can be a great business. They can be a great business at 10 to 20 to $50 million a year, and they can be making good profit. That's an excellent angel play. So that's something that I've learned to look at more over time that I think are unique. Of course, we've got all the other stuff, clear message, who's the other investors, what are they raising, how's the management team, all that stuff is true. But, truthfully, anybody watching this worth their salt will be able to find that on the internet written in 50 million different ways.
Yeah. And It's interesting though. Hearing it'll be something where someone's heard it a lot of times, but hearing it in a slightly different way or with a different inflection can be the thing that finally it clicks for them. Because certainly most of the advice I give
100%.
and throughout this channel is not things that no one has ever said before, but maybe I'm just saying in a slightly different way, and hopefully it's useful. So.
Agreed.
What do you think separates, you've seen a lot of companies come through. You've been with the North Bay Angels longer than I have by quite a bit. Do you have a thought on kind of the systematic things that separate the companies that are successful in raising from the angel group versus the ones, the vast majority that aren't?
Sure. There's a great podcast from the CEO of Peloton. And those guys had a really tough time raising money. And he's got some great stories. I believe that's on How I Built This, but I'm sure you can find articles about him. He has been told so many times, no, so many times it's not even humorous, right? So resilience and the ability to keep going, a huge deal. The biggest piece of advice I have for people who are trying to be successful in raising angel capital is very simple. You have to find a champion. That is the part that entrepreneurs in general don't understand. They think they go through and they go to the event, and then somehow the management of the angel group is going to connect all the dots for them and make this happen. Angel groups are a bunch of individuals, and what they really want to do is they want to see someone internally, preferably that they know well, who says, yeah, this is a good deal, and I put some of my own money into it. I think you should too. So the most important thing for an entrepreneur to do is to find the right person and raise capital effectively with them, work with them, and then use the angel group as an amplifier. That is the best way to do it.
So you would recommend that they focus early on networking with angel investors, trying to reach out, contact them, and build that relationship with one person first before trying to hit the group as a whole?
So if you look at our success stories, I'm going to use one company who can remain nameless, but they're very successful, and I'd happily name them, but I think it's fair not to. North Bay Angels was their first group of money coming in, but I think that they had one of our active angel investors on their board, I'm going to guess for at least 12 months prior to coming in front of the angel group. So they were not ready 12 months prior. So it's not like they were totally ready and they just sat, right? Mm-hmm. They were lucky enough, to use that term, to catch the ear of one of our active angel investors and a board member and all that. And by the time they were ready for money, they came in front of the angel group. North Bay Angels participated strongly, led that round, and then because we, as the North Bay Angels, were strong with this company, we then introduced it to the rest of the InSync Angel group, and they got good follow-up with that group. So they were able to get a rather significant amount of money. They then parlayed that into a good accelerator cohort. Once they got out of that, they were able to eventually get a real institutional round, and they're growing that company and doing well, and all of our stock is worth more than we paid for it, at least on paper.
At least on paper. It's interesting you just...
We hope for a good exit out of that one. Yeah. But to me, that's the real lesson, is that, they started with one person. They worked hard, right? That's table stakes. Smart, talented, all true. Big market, going at it a little bit different way. All that kind of stuff is true. But they started with that one relationship, and then they parlayed that into more and more people, that instead of just, oh, I've got the world's greatest pitch deck. It's like, no, I got maybe a great pitch deck or even a good pitch deck, but I have somebody that you can call that you trust and probably have co-invested in other deals, maybe have seen what this person does when things go badly, all that kind of trust issue. And you can talk to them and they say, yeah, this is what this person does good. I'm trying to have these areas of improvement with the CEO or whatever it is. That's that nuance that, again, entrepreneurs are unfortunately told that, they just need to have the really good pitch deck and they need to go put that out there and then money will fall onto it. And it just doesn't happen. Relationship building, follow up, all that kind of stuff is critical.
I think it's interesting you described this as sort of a lucky thing that for them, but it's definitely the kind of luck that you can make. Right? You can go out and be talking to those
100%.
people and asking for help. I've talked about this a lot on the channel, that angels and a lot of other experienced people, mentors, they enjoy helping. And we talked about that earlier as well. And getting them on board is a great way that when you then need to go for funding, you have a relationship with them and you have someone who's been working with you for some time.
And I can tell you from the entrepreneurial seat, it helps a lot because, there's a lot of dark times as an entrepreneur and a lot of times where the path is at best unclear, if not completely murky, dark, and under the mud. So it's nice to have somebody you can talk that stuff through with that, again, understands enough to not just give you that offhand 1 minute answer, but to really say, yeah, we tried that a couple months ago and, it didn't work then, but I think it might be different now. Let's try it again.
So we've been looking at the angel investment round and working with groups like ours, but you also have been thinking a lot about what that next step is, moving from the seed round to the institutional A, and what that means for startups. And maybe you could share some of your thinking around that.
I've got a lot of thinking on that. I don't have a lot of answers. So I will tell you how it used to be. I got involved in the North Bay Angels in 1998 as an unpaid intern, if you will. And at that time, there was a very clear path. The Angels were effectively the seed scouts for the VCs. And we had participation. Some of our founding members of the North Bay Angels at the time, they were VCs. They're now former VCs. And basically, the Angels would get a little bit of money together for these entrepreneurs, help them get to A level, and then introduce them to the VCs, and the VCs would take them to their Series A round, which was $2 to $3 million, right? That was the model at the time. Now, $2 to $3 million is something called like not really seed. Seed will be $4 to $6 million. Series A is like $10 billion if you're a SoftBank. I joke,
right.
But it's all gotten funny and it's kind of screwy, right? So the problem that I'm seeing is there's not a standard model anymore. And I think the Peloton story that I brought up earlier, I think is very interesting because they did have traditional VC backing, but not in what anyone would consider a traditional way. And we're seeing very large funds. I can say this, I was talking with one of the execs at Founders Fund, and they will do small checks. They'll do 6-figure checks now just to kind of keep an eye on how that entrepreneur is doing, because the VC capital deployment world is so competitive. They want to make sure they have access. So that model is no longer clear. And I think it really depends on what your product is and what the trends are. For Altwork, as a hardware company, we could say that we got unlucky in our timing, because when we were ready for a more institutional round, it was about 6 to 12 months after some of the hardware fiascos had really turned off a lot of the institutional people from hardware, right? So the timing on that, it matters on the micro level and the macro level, right? So there's more VC money out there than there ever has been, but VC money is going to be interested in whatever trends they think are going to provide the highest returns, or that their LPs are telling the VCs they want to get involved with. So I don't have an answer to this. but I do know it's a real challenge today.
It seems like a lot of companies are ending up in this kind of tranche after tranche after tranche of sort of angel-ish, pre-seed-ish kinds of investments as they try to achieve whatever magical metrics some group of venture capitalists is looking for, or indeed sort of bootstrap their way up to the point where the investment might be nice but less necessary.
And that's always the best advice. If there's any way, and then as an angel company, that you can walk in and say, hey, by the way, my company's been profitable for the last year, but I'd like to do an angel round because I can grow the company to this level and then we'd be VC-able. But if it doesn't work, I'm still cash flow positive and I can pay some sort of dividend. That's magic. It's really hard to do, and it's very, very seldom. But the level of certainty that you're going to be able to get that VC round is not anywhere close to as certain as maybe it once was, if it was.
Yeah. And that sort of brings up the point that there's all kinds of businesses that really aren't candidates for either angel or VCs. And I think it's important to kind of have that self-awareness about your own startup when you're running this, that it might not actually be a good fit. There's whole categories of very successful businesses that simply don't work in the model.
Yeah, could not agree more. So first of all, let's just make sure that everybody understands, if you take VC money in, I've said for many years, you have already decided to sell your company, and you are going to grow that company as fast as you possibly can, even if the management team itself is unable to keep up. So that's the negative part that a lot of people complain about, the so-called vulture capitalists, but that's the game they got to play, right? So if you take money from a VC, that's the game you're in now.
Right, and that's because of math,
companies,
right? They just have to do it that way.
It's just math. It's just math, right? And then there are great companies that can take a lesser amount of money, and maybe that comes from angels, right? And they can build a really good company on that amount, and they can provide some level of return that isn't an IPO or this magical acquisition, but they still have a good return. They have a lower end acquisition, or they do an LBO or something like that. So that's all possible. Then there's companies that really are more in the advice area and they cash flow pretty well, but the founders and entrepreneurs are kind of stuck and they need the advice. And angel groups can be good for that too. If they can find something that people get interested in, a lot of these companies are what you would refer to as a little bit more double or triple bottom line type companies, but the founders are stuck. It's never going to be a huge company, but it could be a good enough company, and if they can find the right people, that's great. And then there's a bunch of lifestyle businesses that don't belong with angels at all. I mean, my favorite, I don't know how many times we get this, you're on the program committee, so you see this more than often, but we have the donut companies and the florist companies and all that, and it's just not the right kind of deal. So matching the right outcome to the right investor is a good way for an entrepreneur to think about that.
Yeah. What do you think are the biggest challenges to an entrepreneur when someone's looking to start up a company? What do you think are the things that are the most likely to be major roadblocks or blow up that perhaps they're not looking for?
Yeah, that's a broad question to try to answer. Let me think about it in the following terms. So one, in general, I don't give any advice to people that are wondering if they should start a company, because the answer is no. It's a horrible thing to do. You statistically will make more money working at the coffee bar than you will as a startup person. So let's ignore all of those people, right? Because the answer on that one is clear. The real issue is, so you've already started your company and you're trying to figure out what to do next. I would say the biggest challenge is there's so much press and there's so much focus in today's world about how, okay, so you've started your company, get your pitch deck together, and then Let me tell you how to pitch VCs, and let me tell you about what you should be looking for in a term sheet. And like, there's this whole machine that has developed in the last 25 years that didn't exist before. None of this stuff existed in the 90s when people were doing the internet boom.
Right.
Started in the mid-aughts, and now it's just an absolute machine that's designed to cultivate VC-able type companies. So the first big question is that the type of company you want? And if it is, awesome, because there's a machine for you, right? Number two, most companies aren't that way, and there's not a machine for those companies, so they don't really know what to do. So you got to figure out which hole you belong in. And the best thing you can do is get the business developed as much as you possibly can while you're employed in whatever way you make money. And you can do a lot before, quote, quitting your day job. And I think there's a lot of successful businesses that did that. There's a lot of stories about successful businesses that did that. I think Shoe Dog came out, and one of the stories in Shoe Dog that I was just really blown away by is Phil Knight looked at the business and said, this is a great business, we have a lot of potential, and unfortunately it can't afford to pay its CEO. So he used his CPA degree and was a CPA during the day and worked nights and weekends on Nike until Nike was big enough to pay a CEO. That takes some self-reflection to be able to call that decision.
Yeah, no, that's a really interesting example. Well, I think that's all I've got. It's been great talking to you. I loved getting the update and getting all your insight. Thanks so much, and good luck with the business going forward.
Thank you very much, Lance. Always good to talk to you.
Ciao. Thanks for watching this Feel the Boot interview. I hope you found it useful and interesting, and if so, please do the usual: like, subscribe, ring the bell, and also share this with other entrepreneurs. I'm trying to help as many people as I can. I also encourage you to come join us over at the Feel the Boot Founders Alliance on Facebook. Till next time, ciao.